Welcome everyone to today's session. We're presenting the BBVA Global Bank's Growth Note. My name is Jill, and between Andrew, Chad and myself, we're going to be taking you through the specifics of this note. Please feel free to ask questions as we go along or post them in the chat. And just to note that this session is going to focus on this particular note, but if you would like to go over how and why structured notes actually work, drop us a message in the chat and then we can set up a separate time to run through that with you. So without any further delay, we're going to move on to the next slide. Right. There we go. So just the disclaimer, the usual T's and C's. Cashbox Global is a Mauritian-based financial services organization that's regulated by the FSC there for the international market. We serve an ever-growing global community of like-minded investors and advisors who want to add defined growth and income streams to their portfolios. Through education and awareness, our community can access and secure investment contracts offered directly from Europe's strongest banks. We design and provide access to these structured contracts called structured notes, and Cashbox Global does not provide any advice. The presentation covers product information for education only and is based on research that we've done personally and the actual results that have been achieved. We always encourage you to conduct your own research and due diligence. And just remember that past performance is not an indication of future performance. And with that, I'm going to hand over to Andrew.
So hi, everybody. Cape Town is very warm, unusually so. So that means bad weather's coming for the rest of the country and probably ourselves. I know a lot of people from Nelspruit. We were up there recently in the Lowveld, lovely part of the world. And congrats to Pumas for winning their maiden Currie Cup. For those who don't understand what it is, South Africa's religion is rugby, one of their religions. But great to have winners from that part of the world for a change. So when we were up there, we had a futurist and political economist, Daniel Silky. Many of you came to see him and listen to him. And I think in a nutshell, this picture tells a story. There's a lot of confusion, there's a lot of headwinds, there's a lot of pressures, both vertical, horizontal, and sideways, back to front. It's pretty much like that spaghetti looking a roller coaster that we're all on at the moment. And yeah, coming into this year, we all thought that 2022 was going to be a very different year to what the previous two were, which were frankly very weird in terms of what happened to the world. I'm not going to go into the past, but I think we all anticipated that 2022 was going to be a little bit more normal. Because of what had happened in those preceding years. So coming into 2022, we were already talking about interest rates. We were already talking about inflation, overheated economy, supply blockages, COVID hangovers, transitioning back to work at the office as opposed to purely from home, and the hybrid models. And all that went with it. And then thrown into that was a European war, which wasn't a European war. It's actually got global ramifications and global impact. And all this mixed up together creates a huge headache for investors, people like you and me, for people predicting where markets are going to go, etc. So, in confusion, one of the mantras, one of the strap lines of Cashbox, of structured notes, is that they are if I can call it a bearish investment. They are designed to work in certainly upward markets. As well as sideways, and in fact in declining markets as well. So it fits perfectly into into these sort of headwinds, this confusion that we're seeing. There's a lot of noise going on, and it's moving very rapidly, very much like what happened in COVID. The developments into a digital space, we are moving rapidly in terms of what's happening this year. And some people say, well, there are certain people in the world with a finger poised over a big red button. Where do I put my investments? Well, if that button does get pushed, there's really nowhere to hide. But in the meantime, we've got to make sense out of this this picture that we're looking at. So a lot of confusion. There are some green shoots showing, we believe. But in terms of structuring our products, I mentioned bearish products. We try to build them with airbags and seat belts and as much protection, crumple zones, as much protection as we can. And you'll see some of those protections that are built into the T's and C's. The structured notes are contracts, they're underwritten. There's an obligation, a legal obligation for the company, where it is regulated, where the bank is regulated, to comply with those T's and C's. And we have very robust negotiations and very robust discussions with the issuing bank, with the investment bank, the dealing teams, in terms of making sure that the product works for them and it works for us, and it's a win-win situation. Banks aren't charities. Investment banks certainly aren't. I always say that, having worked for 20, 25 years. So the protections that we're looking at have certainly paid dividends. So in other words, I'll just run through, and Jill will deal with it a little bit more detail in terms of an overview of the T's and C's of this particular product. We look for deep capital protection. We look for an opportunity to get a superior to retail payoff in terms of whether it be growth or whether it be an income-styled quarterly coupon. So that straight away takes us out of the realm of retail, because retail, you just don't see these type of products with these payoffs and these levels of deep protection. Secondly, we always look for a very, very solid, strong tier one investment bank. So pretty much an A rated or in that ranking. So when I talk about A ratings, I talk about generally the three major rating agencies, the Fitch's, S&P's, and Moody's, and they can get it wrong. We saw what happened in the 2008, 2009 financial meltdown. They can get it wrong, but the governance that's been brought in, the testing that's been brought into banks, because banks are writing these issuances, these notes off their own balance sheets. So it's got to pass muster with quite a few of their internal checks, whether it be credit, whether it be investments, especially on the investment side. Because banks make money out of these products, not just in taking our money and using it, but certainly in terms of what they trade the options of the underlyings onwards into the future. We talk about why banks again. We've had, there was a slide we showed in a previous webinar. So we moved to banks pretty much around about, I would say, the second quarter of 2021. So that was some time ago, pretty much this time last year, where we felt that I always call it the rubber band rebound from the bottom of March 2020, where COVID took us right down that mine shaft and nobody knew where the end was in sight. But the rubber band recovery was led by digital tech, semiconductors, and the digital space. And we felt that many great companies, many defensive stocks were left behind. They weren't in value. They weren't in vogue. They were literally the bridesmaid at the party. And it became more and more apparent that this overheating in the economies of the world, where it was a free for all in terms of free money supply, literally zero interest rates. Inflation wasn't even thought about. Recession hadn't even been lost in the lexicon, in the vocabulary of people. And the way, the strength of the recovery was a little false, because it was very narrowly led from a very small sector. So we started piling into these banking stocks. And I think during the course of last year, we probably had 4 that have all auto-called. In other words, they all early matured. Within 6 to 12 months, they matured. And we felt that there was still steam coming into that sector during this year as well. If we look at the particular slide that's gone up, why banks? Banks are somewhat boring. They reflect the health of the economy. They represent lending and they represent borrowing as well, and deposit taking. And during COVID, literally, they were unloved. They really were unloved. But they were literally in the wings, waiting for the opportunity. Banks normally in a portfolio, in terms of portfolio construction, are cyclical. In other words, they move in tandem with the cycles of the economy. When economies are taking a beating, banks are taking a beating as well. They've got their customers, are you and I, who are getting deeper into debt, who can't service debt, etc. So a lot of the time, banks are chosen as big, steady eddies to bring some gravitas to a portfolio defensively for their yield, for their dividend yield that they would produce, rather than out and out growth like a tech stock, like a Google or an Apple or a Tesla. But banks were heavily impacted. Before March 2020, as you can read, their interest rates were already dropping. There was talk back in 2019 of, is there going to be a hard landing? Is there going to be a recession? So that was 2 years ago. So we've gone through this huge 2-year aberration. And during this period, during 2020 up until pretty much the end of last year, central banks just kept the money pumping to the commercial banks. So rates were low, lots of liquidity. It kept businesses open. It kept people afloat. And banks also, as you can read there, made very large provisions on their balance sheets for defaults, for credit going bad, if I can call it that. So they put these massive amounts of money on their balance sheets into a provision to basically provide for bad debt. Now, what's really happened in the last 24 months is the superheated economies of growth around the world certainly have now come to bear. And what's happened is that there's overheating. I'm constantly surprised when I look at markets on a daily basis, and I read some of the comments that people are getting, there's a knee-jerk reaction to the fear of inflation and interest rates and recession now. That's been spoken about. The narrative has been there for the last 6 to 12 months that it's coming. But when it does come, when there is an interest rate by the Federal Reserve or by the European Central Bank or by the Bank of England, panic and mayhem, and there's a chaos on the market that I don't quite get it. It's the human avarice, I think, that comes through. But banks have stopped that free party. They've turned off the tap. Okay. Now, if you can imagine, people are now having to tighten their belts, but at the same time, interest rates are going up to combat this overheated growth and inflation. So what that means for a bank is that its net revenue, its revenues on net interest becomes greater. In other words, the debt that we're having to service, whether it be for commercial, residential, lending, you name it, it becomes more important to a bank in terms of their total assets, what they've lent out, because they're now getting a bigger margin on it. The margin is obviously dependent on it being serviced. That's the other thing. So it's a good idea to talk to your bank manager. But banks will profit out of that. And if you can see, I mentioned we had 4 or 5 order calls last year. We've had order calls this year on banking sector. This rotation from high growth into this value setup with these big companies that are just slowly moving up the value chain, it's paid huge dividends because the bank is prepared to pay a premium for its cost of capital. It's going to give a great coupon. We'll take you through those because we missed the first slide, so we're a little bit in the dark here. But great, both sterling and US dollar, great payoffs. But they want to get out of jail card free quickly. They don't want this to go on forever because their cost of capital becomes expensive, not only to their balance sheet, but shareholders, incentive pools, you name it, in investment bankings. So, we've stayed with, I mentioned that our issuers, so that's the bank who underwrites the contract. In terms of the 4 banks on the screen now, we've used 2 of them. In fact, 3 of those banks we've used as issuers themselves. So these are all very, very large, well-known household name banks. I would like to think that they're pretty much international investment banks, but they do have particular focus in their own geographic area. Commerzbank is specifically German orientated. SocGen, Société Générale, is mainly French or European. BNY, Bank of New York Mellon, is effectively a US investment bank. And Barclays, well, they are truly global, but headquartered in the UK. And I think what we've looked for, to go back to that previous slide, just in mind about what airbags we build in. We build in both from an issuance perspective, the bank issuing the contract, as well as the underlyings, is that there has to be a good story. There has to be a comprehensive reason to hold these within a basket of the underlying constituents. So Cashbox and IDAD, together with the investment bank, in this instance, it's BBVA, the largest Spanish bank, look at is there going to be that win-win for both sides of the contract, both for the bank as well as for the investor? They want our money, but we want a return, and they want out as soon as possible. So these are now we're getting into the actual nitty-gritties of the actual product. So maybe if I'll just take you through them. The issuing bank, as I mentioned, is BBVA. It's a Spanish investment bank. It's probably about the 16th largest investment bank in the world, based in Madrid, but worldwide. Let's go. It's a growth opportunity. So this does not distribute or pay a quarterly coupon. It rather accumulates those coupons, and those coupons will only be paid out on a certain trigger event, which we'll talk about. So let's have a look at these accumulating coupons. GBP 4.5% per quarter. That's 18% per annum and 5.5% US dollars. Those are really quite frothy coupons in terms of what we are actually, what banks are prepared to issue for capital at the moment. That's underwritten. There's an legal obligation for the bank once it signs this off, once it's been issued with an ISIN, to actually fulfill those terms. The term is a maximum of 4 years, but subject to, as you can see, those two little stars there. So it can run for a maximum of 4 years if it doesn't auto-call. So that's the next line, the auto-call trigger. What does that mean? Basically, it is an event that would cause the contract to end early or prematurely for some, but it would end the contract. And what they're saying is they're 95% of the initial value. In other words, those 4 companies that we mentioned, those 4 banks, will have a starting price on a particular date, and they are measured per their closing prices on the particular index in which they are listed. From 6 months and then quarterly thereafter, if all 4 of them are above 95% of the start price, okay, then the bank has the legal obligation to halt the investment, to close the investment, to end it. The full nominal, in other words, your full initial investment is returned, as well as the number of quarters that will have elapsed. So let's say in the end of the 3rd quarter, effectively that's 3 coupons worth that would come to you plus your nominal. So I call it a snowball. They call it a snowball. It's a bit like it rolls down the hill, gathering these coupons every quarter. And as soon as all 4 rise above 95%, so all 4 have to. So we don't need these shares to shoot the lights off. They can pretty much hang around from where they start, or they can even degrade by 5%. So you can see the bank has sort of left the back door open for it to exit from the contract. The reference basket, we've mentioned. I will say there's a rationale on the website. We can email it out. I know Jill's been emailing out to a lot of people. There's a rationale that goes into a lot more detail. I've run through it quite quickly this evening. I think at the end of the day, we're all tired, but there's much more detail if you want to delve a little deeper. Capital protection, this runs for the full time. Okay, so from the moment it launches to that end of the 4th year, end of the last observation, your capital is underwritten. It's at risk. It's important to know this is not a capital protected product. It is at risk. It's at risk at the very final observation, okay, on month 48. And it's protected to the level of the bank will allow those shares to degrade up to 50% from their initial starting price. In other words, effectively those banks would have to halve their balance sheet, halve their value in terms of what their stock price is. That's a serious degradation. I think that's when the big red button's been pushed. So very, very deep capital protection, and that is something to go back to again. In troubled times, in uncertain times, uncertainty is the worst fear, quite frankly, in anybody's life, certainly in investments. So to have that contractually built in gives a great sense of comfort. The availability is that there is a subscription period. This is not an open-ended investment. It's a start, subscription period, and then there's an end date. That end date being the 8th of July. So the funds, your investment funds, would need to be on your investment platform, dealing tickets signed or dealing instructions completed, and funds available 8th of July. The strike price, in other words, they fix the price of the actual 4 shares the following day, and then it issues normally a week later. Minimum investment is 2 currencies, obviously, per the coupons that are being made available in sterling and pounds, both at 10,000. I think, Jill, the next slides are, I'll take you through this as well. So this is important dates. I particularly like these because it gives some certainty in terms of the contract. You know, whether you're an old-fashioned guy like myself who writes it in my diary, I still own a diary I lug around with me and lose regularly, whether it's electronic, it gives you some sort of a roadmap in terms of milestones when these payments, these observations will be made. And it goes from one to the final observation. These don't change, they're set in stone. Observation dates are there. The payment date is always generally about a week later. And there's the trigger. We've spoken about the Autocall trigger. So it has to Autocall for these coupons to be paid. So let's say observation, let's say it runs 9 observations, that's 9 quarters, okay? So it goes down to observation 9, they rise above 95, they equal or above 95%. On the 13th of January, 2025, it seems a long time away, this would end, and you'd pick up 9 coupons plus the 10,000, for example, that was invested. So it gives you a fairly straightforward matrix in terms of when you can expect. Cashbox, what we generally do is just before each quarter, we would put out to the advisors, we'd put out to clients directly if they're self-led to say, right, we're actually looking as though this is actually going to Autocall, we'll keep you posted, etc., etc. But it's very easy to track in terms of whichever platform you're using. I think that's pretty much it in terms of the metrics. I think, Joel, the next slide is on the actual sort of how do they work briefly. So maybe you'd like to go through that.
Yeah, sure. Just apologies for the dogs barking. It's crazy in the neighborhood. Yeah, so just to kind of recap, what happens is on the strike date, they measure the price of the underlying stocks that they'll use as a reference point at each quarter for Autocall. So they will always measure against the start price. So in this example, as we go along, it needs to remain. In fact, it doesn't matter where it is, the first and the second and the first 6 months, because it'll just pick up that snowballed coupon. The product needs to Autocall in order for the returns to be paid out. It can't not Autocall, it must Autocall in order to get the funds paid out to you. So what happens is the Autocall level is set at 95%. So from 6 months, as long as the worst performing stock is over 95%, the product will Autocall close and the funds will be returned together with the number of quarters that have passed. So in this example, you'll see it's 2 quarters, but if it was quarter 4, it would be 4 quarters before it Autocalled. And then you have a capital protection barrier that runs at the bottom, but this only actually comes into play at the very last observation, should the product last that long, which, as Andrew said, it's not designed to do, because the bank certainly doesn't want to keep this for an extended period of time. So this is just an example of how, should the product run and it goes below the Autocall level, and say in quarter 4, it raises above, it crosses the Autocall level, the product pays out and it multiplies 4 quarters by the return, and that is what comes through to the platform, to the investors platform. And then in the event, we often get asked the question, but what if it doesn't Autocall? So as I said, the product must Autocall in order to pay out the returns. So what will happen, say an example, it ran and it went all the way to the end of the term. At that very final observation, as long as the underlying stocks have not halved in value, because that's the 50% protection, full capital will be returned. Because this is a growth note, there won't be an interest component paid out. So that's why we keep saying it must Autocall. And if you think about it, banks the size that they are, and the market that we're in now with rising interest rates, the likelihood of it Autocalling is exceptionally high. It's not likely that they won't Autocall. And that's what they're designed to do. So that's for that. And then just to access the investments, for those that aren't aware, you do need an investor platform. This is just an example. This just shows you how the whole program is regulated. We work in a highly regulated environment. But in order to access it, you do need an investment platform. We are platform agnostic, and As long as the platform will hold our structured notes, you will access them through an ISA number, which we will provide, and the funds flow from the investor onto the platform and into the product, and it comes out the exact same way. If you don't have a platform, there are platforms that a number of our investors do use. We can help you with some of those just to have a look at and then go from there. And then just in closing, I don't know if there are any questions along the way. It's been quite a disruptive evening this evening. Are there any questions at this point?
I think Matt's got one.
Jill?
Yes.
It might be a stupid question after all this time, but the 50% capital protection, must it be for that to be triggered? Does it have to be on the day in 4 years' time at the expiry on that day?
Yeah.
Not any time before. It must
No.
be on that day. So the chances of that ever happening are highly slim.
Yeah.
There's
Yeah.
it.
So the product is underwritten by the bank for the full term. The only time that that there is a potential risk is the very final observation. But as we said, they're designed not to run to the full term, and historically they haven't.
Thanks.
Yeah, Matt, it's a good question. There's two actual barriers, and it's always important. I always say to a client when they look at a structured note or a structured product to have a look at the type of barrier that has been built in by the bank, and you get two. We pretty much only use what's called a European barrier. Okay, you'll see that touted around in the fact sheets, the formal fact sheets. You also get something called an American barrier. So a European barrier basically means that during the lifetime, during the 4 years of the product, even if those shares bomb out to 10% of their value or 20% of their value, it doesn't make, there's no difference. It's that very last observation date. That's the date that's salient. Whereas an American barrier means that pretty much during the lifetime, that if it touches that 50% at any stage,
Sure.
you taint it from that moment onwards. Yeah.
Okay. Thanks.
Maybe if I could add, Jill, if you could go up one slide, I think it was. So, Matt, to your point, if we go and have a look at the last 5 years, every product is auto-called before full maturity. And we just did analysis now. So the structured notes we got into last year with growth have run approximately 9 to 12 months on average before they've all auto-called. So typically, as Andrew was saying, you would normally put big banks into your portfolio for a steady growth, maybe 5 or 6% per year. We're saying it can be flat, even minus 5%, and the product will close. So all this protection built in makes this a compelling investment and a nice balance, because you can create income-based structured notes and then these growth-based notes. So as a portfolio of structured notes, this is a lovely place to be. And then, Matt, you've been in a couple of income products as well. You notice the coupon is bigger, right? Because the bank is not paying out a quarterly flow as they would in an income product. They're going to pay out a lump sum when they've made their money, right? When the product has produced for them. So in that regard, they typically then actually build a growth coupon bigger because there's no cash flow implications to them right until the last date. So when we did our analysis again between last year income notes and growth notes, our income notes were running at about 14%. That's coupons being paid out per annum on an annualized basis, where the growth-based notes are close to 20% kind of mark. So yeah, a great product, to try and find funds that would beat that. And as Andrew said in those schedules, exactly what days and under what conditions it's going to pay. A lovely investment.
Thanks.
Okay, and then just in summary, why these products actually work is the bank needs to be comfortable that the exercised stock options will cover the cost of borrowed money and they're going to make a healthy profit. And from an investor's perspective, you need to be confident in the strength of the bank, which would be BBVA, which is one of the 16th largest banks in the world, and that the underlying stocks will not halve in value. So when you're looking at bank stocks, they're not the sexiest stocks, but as far as they don't go up shooting out the lights, they don't go in the other direction either. And that's exactly what you're looking for in this type of a note for it to pay off. And if you have a look at the bottom there, it says in the last 5 years, there have been over 245 growth notes that have been issued. 91 are active, they're still running, and 154 have auto-called as they expected. And the average duration has been around 3.5 years to auto-call. So they're really not designed to see the end of the term. And with that, are there any other questions that we can help with?
Well, if I could just add one thing. I was asked by a family office client this afternoon about the momentum that is still in banks, and was the momentum that we experienced last year with a lot of auto calls, for example, producing early maturity. Was that still evident? Was that still possible? And I suggested to them that at the moment, if you go and have a look at the valuations on these 4 particular underlyings, BBVA has done their homework, because all those banks have retraced in terms of their valuations are probably at a better price earnings level now. They're getting a bit technical, but with the rising interest rate cycles, these are normally long cycles. In other words, banks rose on the tailwinds, on the tailcoats of all those other tech sort of led to recoveries last year. What they're doing now is they're recovering on more fundamental reasons, in terms of net income is going up, in terms of interest rates. A lot of those bad provisions are coming back onto their balance sheets and flowing into their P&Ls. So banks, as you say, they move slowly, but the momentum, we don't need a lot of momentum. And with those great payoffs, it's still there. It's still there to be taken. Interest rates aren't going to stop tomorrow. I said earlier, I'm always surprised that people have knee-jerk reactions. Say, oh, the market's been crazy today because people are fearing recession. The Federal Reserve said last week, there's another 275 basis points coming, guys. Factor them in, price them in. But I can guarantee you, when they happen, when they meet next month or in 2 months' time, there'll be another knee-jerk and things will go a bit haywire. But safe to say, besides the geopolitical effects, banks, and we did look very carefully at the connections, SocGen, for example, back in February, March, April, came under a lot of pressure on its share price because it had probably the largest Russian exposure of European banks. We don't try and cover up the warts and all. So a lot of their debt might not be repaid. Russia's starting to default on some of its sovereign debt now. But the fact of the matter has been priced in. Nobody likes uncertainty. We know what's in those share prices now. And if you look at them individually and on the fact sheet that is available, we do an algorithmic little chart of each one, and you'll see there's good value. And in rising interest rates, fantastic opportunity to get in. And as you say, as long as we're 95%, we'll end. This particular client says, well, I don't want it particularly in because I might not be able to arrange these rates for a longer period. So the risk is that it might end early. It might end after 6 months, which is its first order call. I'd like it to go for a year because then you're extracting 18 or 22%. That's a nice bankable number. I like that. But yeah, as you say, Chad, correctly, as you said, most of the notes that we've done in this banking sector, shortest one was 6 months, and the longest one I think has probably been about 18 months. So yeah, round it off to 12 to 15 months, and they're done. So great opportunity. That's it. Yeah.
Cool.
And now for a glass of wine.
Jill, you're nice and quiet.
I know, it's because I was muted. Distractions. But what I'm going to do, I'll send through the recording once it's been edited to everybody. And the rationale and the fact sheet are on the website. And then if you do want to look at the product, just let me know, and then we can get the ISIN number through to you. And if there is anybody that needs assistance with a trading platform, let us know and we'll be able to help you with that as well. And with that, thank you, good evening, and hopefully not sitting in the dark for too long tonight.
Cheers.
Thanks, Jill.
Thanks a lot, guys.
Good
Cheers.
night.
Bye, guys.
Thank you. Thank you.
Bye-bye.